Hey everyone, me Kevin here. You want to know what the Federal Reserve's doomsday scenario is for the market, specifically the stock and housing market over the next potentially few months to a couple of years? Well, they basically handed it to us on a silver platter. Now, you may not have heard about the doomsday scenario because the doomsday scenario was buried in the Dodd-Frank stress tests of banks and financial institutions. And if you just saw headlines of the stress test, you probably would have only heard something like this. The tests show that large firms have sufficient capital levels to absorb losses during stressful conditions. This is due in part due to substantial capital buildup since the last financial crisis, and the results suggest that all firms would experience substantial losses, but would remain well above their minimum risk-based requirements and could continue lending. Or if not all, then at least 23 of the firms that participated. But this isn't about saying, yay, okay, the bank stress test went okay, all right, what else? This is about looking and understanding what the adverse scenario entailed. How much did the stock market drop in their scenario? How much did the housing market drop in their scenario? When did these drops occur? Now, what's kind of interesting but also a little weird to think about for this scenario is this scenario was conducted in February. So we're really only now getting the results of this. So some of this feels a little weird since technically we're already in the second quarter. In fact, the second quarter of 2021 is almost over. It comes to an end in 5 days. Just like my course coupon code linked down below for all of my programs on building your wealth, including stocks and psychology of money, which 40% off coupon code ends in 5 days. All right, but more importantly, we must talk about the severely adverse scenario. This is the hardest scenario under which the banks were tested under. This means the Fed thought, hey, what is like the worst we could throw at these banks to see if they can withstand it? And let's see some of the variables they changed to indicate this crash actually coming. Some of them surprised me, and I have a feeling they'll surprise you as well. All right, and if any of this stresses you out, remember, go to metkevin.com/life. For life insurance, you can get in as little as 5 minutes, or metkevin.com/lemonade to price shop. metkevin.com/life or /lemonade, or both. All right, here we go. The severely adverse scenario is characterized by a severe global recession accompanied by a period of heightened stress in commercial real estate and corporate debt markets. Sounds a little familiar to 2008, but okay. The U.S. unemployment rate climbs to a peak of 10.75 in the third quarter of 2022. Why would they pick that? You know, I personally like reading these because it's like, wait a minute. What is it about 2022 that you don't like? Anyway, unemployment rate rises to 10.75% in the third quarter of 2022, a 4 percentage point increase relative to its fourth quarter 2020 level. Real GDP falls 4% from the end of the fourth quarter of 2020 through the third quarter of 2022. What is it with the third and fourth quarter of 2022? Is this a suggestion that there's gonna be some stress at the end of 2022? Maybe, I don't know. It's just their scenario, right? Or so they say. The decline in activity is accompanied by lower headline consumer price index inflation, which quickly falls to an annual rate of about 1% in the second quarter of 2021. Now, we know this is wrong because right now we're not seeing that. However, what's really freaky, and so this is why I kind of preface that you kind of want to avoid considering their second quarter of 2021 talk because, well, this test was done in February, and this is not true. Like, inflation right now is higher, way higher than an annual rate of 1%. We're at an annual rate of over 4%, okay? So consider that for a moment. It's kind of weird. What they're talking about in their scenario, even though this timing is not possible anymore because second quarter of 2021 is over, what they're talking about in their scenario, which they're worried could potentially, or is their test scenario, I'll say. I'm not saying that they think this is what's going to happen. It's just their test scenario, right? So Q3 to Q4 2020, they think the characteristics that could lead to a crash like this would be high unemployment of 10.75%, inflation actually going down to an annualized rate of 1%, and then GDP falling at a total rate of 4%. This is really interesting to me because 2022 is going to be marked by a very fascinating set of inflation data. In fact, we've talked about this on the channel before, but consider this. If prices for certain widgets goes up, let's say 10% in 2021, because in 2020 it was, let's say, $100, and now all of a sudden it's $110. That's a 10% increase. But if the price, because supply chain shortages fixes, gets cleared up or whatever, and goes down, then what do we end up having? We have a deflation rate of 5% for that particular product. Well, if this happens and this cleans up, or the supply chain crises clean themselves up, and we get this happening in multiple different segments of the markets, yeah, it's actually possible that headline inflation could fall to 1%. Kind of creepy to think about, but like that path is there. Okay, so let's go back to the scenario here. So, and then stays at the level for another quarter before, here we go, gradually rising to 2.25% by the end of the scenario period. So also weird. They're kind of suggesting this temporary fall in inflationary readings, which we have here, and then an increase again in inflationary readings. Here, let's use the red. There we go. So really, you get this big spike in inflation, followed by a decline in inflation readings, and then an increase again. This is chartable. Like, this could make sense. That could be what happens, which is kind of interesting. In line with the sharp decline in real activity, the 3-month Treasury remains near zero, and the 10-year yield falls to 0.25%. Folks, 0.25%, right now, we're at 1.5%. So a little different here, right? So again, ignore this talk about quarters of 2021, because this is just their scenario here. After which gradually rising to 1.5% by the end of the scenario period. So this is interesting because this is where we stand now. So this is a little counter to these scenarios that we have over here, but we'll write it down. So we'll put 10-year 1.5% towards the end of the scenario period, which is basically during crash time. All right, let's now move forward. Oh, worth also taking a peek at some of these charts, and then we'll get the numbers on equities falling and housing prices falling. So look at this, GDP growth in their adverse scenario. Look at this. Here's that V-shaped crash down. Then you get this explosion up, which we're seeing now. But look at this. This is something else. The projection, and again, this is not a projection of what is going to happen. This is just a projection of if this happened, how would banks be able to hold up, right? So you have to keep that in mind. But that these are the scenarios they're talking about of potentially having this overcorrection to the downside and then rotating back up. It's kind of like you got this insane velocity to the downside, but then this insane velocity to the upside, and then when you go back down to stabilize, you actually correct down a little bit before stabilizing. Kind of weird and interesting because it could happen. Here's what they see for house prices. They see that in their scenario, about midway through their scenario, Q3 2021, I drew this little red line for Q3 just so you would see. They see housing prices potentially falling and then coming back up. And this is a substantial fall. I'll tell you how much in just a moment because they write that down. And then this is what they see for the Dow Jones. This incredible skyrocketing that we're seeing now. And then this U-shaped kind of fall and recovery again. Corporate yields, the inverse here. Okay, now, you ready for declines? You ready for this? Okay, here we go. So, conditions in corporate and real estate lending markets deteriorate markedly. The spread between yields, blah, blah, blah. Most of us don't care so much about spread and yields. If you do, pause and then read it. Here we go. Asset prices drop sharply in this scenario. Equity prices fall 55% through the third quarter of 2021. Now, we have to, again, revise this because we're literally going to be in the third quarter of 2021 in a few weeks. But the point is, if there is going to be a crash ever like this is how much they think stocks could fall. 55%, accompanied by a rise in the volatility index, and house prices and commercial real estate prices experience overall declines, with house prices falling 23.5% through the end of 2022, and commercial real estate prices falling 40% through the first quarter of 2023. Then this would cause severe recessions in the Euro area, the United Kingdom, Japan, and a significant deceleration of activity. This also assumes the largest counterparty collapse at banks, which ends up leading to a flight to safety, which could prop up the US dollar despite seeing these declines. But this counterparty collapse could lead to the greatest losses in derivatives and lending. Derivatives, folks, in case you don't remember, derivatives, what do you think options are? Are options valued based on their own performance, or are they derived from the value of something else? Yeah, folks, options are derivatives. So this scenario really kind of scary. Something to pay attention to. It's just a scenario. It's a scenario that was created in February 2021. I just find it very, very interesting that the suggestions of what could cause or be a result of this recession. It's not very clear if we're talking cause or effect of some of these things. Some of these things could be effects. GDP falling 4%, inflation down to 1%, unemployment 10.75%, real estate prices then falling stock prices falling 55%, real estate prices falling 23 to 55%. But I have to say it's a little weird to also consider that, well, we could see inflation inflect downward before going back up. It's also a little weird to think that, yeah, we are having this crazy recovery to the upside. What if we do overshoot to the down before we stabilize again? It's a crazy scenario. It's certainly a scenario that, again, sort of reiterates to me personally, like, Kevin, you probably want to reduce some of your risk exposure to options. This is something I've been talking about doing for months. Reducing exposure to margin, reducing exposure to options. Very important. Consider it, keep it in mind. Okay, folks, I hope you enjoyed the breakdown of this. If you did, consider subscribing. Check out the program's link down below. And folks, we'll see you in the next one.